And welcome. This is Mary Ellen McGonagle, and you're watching the MEM Edge Show, brought to you each and every Friday afternoon. And those of you that are new to the show, this is the show where we put you in front of where the action is in the broader markets. Our goal is to certainly make sense of what's going on. We've had quite a hectic week, and again, we want to break it all down so you can set things up for next week for a week of success. So let's go ahead and get started. Here's what we're going to be covering today. As always, we are going to drill down, take a look at the conditions of the current market. Again, it's been quite volatile week all the way around. So you want to get a stand or a feel for where precisely we are and where we may be headed going into the next couple of weeks. And then we're going to take a look at some of these stocks that are holding up well, and a number of them do have historical precedent as far as being able to hold up well should the markets enter into a recession. So we're going to take a look at a couple of those stocks. Also, we can take a very quick look at various market cap sectors, large, mid cap, and so on. Take a look at some of those outperformers in each of these market cap segments, and there'll be a dual purpose for this exercise. One is when you are in a bear market period, you want to be able to build your watch list, have a list of stocks so that when the markets really come back into a healthy phase, these non-defensive stocks that are outpacing the broader markets historically will go on to be your leaders in that next bull market cycle. So that's one reason to pay attention currently to those outperformers. Also, there are some outperformers that are a bit defensive in nature. Some of you, particularly for investment managers or professionals, you are mandated to stay mostly invested, certainly not fully, but mostly invested. So you'll want to know about those outperformers as well with an eye toward defensive stocks. And then from there, using history as our guide, I'm going to take us back to a couple of other historically difficult periods in the market. And we can use this history to help gauge and form a very educated opinion as to how the markets may play out. Now, of course, each period has its own set of parameters. We're certainly in an unprecedented period, but as it relates to the stock market, certainly looking back at fear and uncertainty and how that played out. So let's go ahead and get started. As you can see, we have a fair amount that we are going to go ahead and cover. Let's take a look at an initial view here. I want to take us to the current markets as far as the S&P 500. We're going to take a look into the close today. Of course, the markets were up down 9.5% yesterday, and then up 9% today. So it really brings that concept of volatility to a whole new level, certainly in recent history. So let's take a look at where the action this week has taken us, because we've had 2 days, a particularly strong down day, 5% down on Monday, 5% up on Tuesday, down on Wednesday, and so on. So just a lot of back and forth. And really what this is showing us is the clear-cut, intense uncertainty that's surrounding this coronavirus, and the fact that we're not sure as far as containment, the ability to do that, and then the impact economically. So again, this volatility very evident here, huge uptick in the volume as investors, the bulls and the bears, fight it out, so to speak. So let's take a look beyond the price bars for this week and look at some of the other indicators that we have. Before we do that, just as a reminder, I do have these simple moving averages on the chart because they tend to act as support and resistance. And this green is your 10-day, red is 50, the blue is your 200-day. Now, this recent action that we've seen on very high volume has pretty much sliced through each of these simple moving averages on the downside and beyond. And in essence, the severity, the swiftness of that has negated, for the most part, this concept of support, but we will still use history and take a look at some probable ways that this current market may carry on. So in essence, we have other outlying indicators that I like to use. On the top here, we have what's called a relative strength indicator, RSI, taking us back to this nice, healthy bull market period that began in October in the S&P. If I didn't mention, this is a daily price chart. We can see that the RSI remained bullishly above this net neutral, and that, of course, is healthy. More recently, with the break that began several weeks ago, the RSI did break down below into negative territory, below this dash net neutral. And then from here, we're bouncing around as the market really tries to find some sort of stability. So it is emerging from an oversold position, but it remains below this dash, certainly in negative standing. Below, I have another momentum indicator. It's a MACD, moving average convergence divergence. And again, during this healthy period, it resided up above this net neutral zero. And then with the break in the broader markets, we can see that that MACD is just heading very south. We can take a look. I'm going to share with you historically what we would need to see to have confirmation that at least the markets have stabilized, if not turned positive. So from my work, we are in a bear market. You're seeing these big ebbs and flows. Again, we're going to take a look historically, but I would argue it is a time to, more importantly, gather that watch list, get ready for a healthier phase rather than the frustrating up and down that we are experiencing currently. So let's move on. We want to take a look at, as I mentioned, some other views of the S&P 500. And this is a monthly chart. I believe I shared this with you last week. And really, it's going to provide insight, taking us back to two other bear market periods, the 01-02 into 03 bear market, and then, of course, the 08-09 financial collapse, and then comparing that to where we are now. So this is a monthly price chart. Each bar is 1 month of activity. And then I have a 6 as the simple moving average, a 6-month simple moving average. A couple of other indicators here. We can see the RSI. And now I'm using the stochastics on these longer term charts. Stochastics have a tendency to give you a bit of an earlier clue. So I like to use that as opposed to the MACD. So we can go back historically and take a look. Certainly the 01 into 03 bear market, some of the characteristics. We had the RSI turning negative, but our first real key clue was the price breaking below the 6-month simple moving average. And then we can see the stochastics. I talked about this being a nice early indicator. The stochastics, this momentum indicator, did turn negative certainly earlier, and then we had this price break. So this was your first signal that all was not well with the S&P 500. And then likewise, as we go into the 08-09 bear market, we got this early break in the stochastics, that warning sign across the bow. Now, of course, on the opposite side, you'll get a nice, conceivably early signal that we've emerged out. But let's take a look at where we are currently. I've gone ahead and highlighted the December 2018 low that is supposedly due to be the next possible area of support. Currently, with today's close in the markets, we are about 17% above this December low, just as a metric. But take a look, we have the RSI is negative, and that is one of the signals here. And then the stochastics, not quite, they're still in neutral territory, but by all accounts, we are certainly in a bear market. Let's take a look very quickly at some of the characteristics on this monthly. We'll take a look at a daily chart as well. On the downtrend reversal, the anatomy, what does that look like? Your first key is a break back above this 6-month simple moving average, and that's going to be in line with the stochastics turning positive. Again, this RSI is going to be a little bit later as a confirming indicator, but certainly these two metrics by themselves would be one way of signaling. So that is your monthly chart. Let's go ahead and take a look at another view, because we do certainly want to use history as a guide. This is a daily price chart of the S&P 500. A lot of people have been referencing that 1987, that Black Monday. And on this day, the markets dropped over 20%, huge gap down October 19th. And really just looking at this daily price action beyond that October, it was not until the beginning of 2018, so that was over 2 months later, on this daily price chart, that things did turn positive. Your first clue again, price breaks back up above these key simple moving averages, in particular your 50-day, MACD turns positive, and then you have a positive RSI. So that's using a daily chart as for the indicators that you are going to want to be looking at. And one last view that we want to look at is what's called capitulation. There was a lot of information. Certainly yesterday we had that big break. The Dow was down 9.9%. So a 10% down day is one of the potentials for capitulation. For those of you not familiar, capitulation in essence is when all of the selling gets puked out, for lack of a better word. And oftentimes it's not going to be an exact signal of a bottom, but it can signal the markets being close to a bottom. So here's what I wanted to point out to you here is what that capitulation looked like back in December at that 2018 bear market. December 24th, we did get a capitulation day where the markets undercut down on huge volume, and then it did close up for the day. The volume on that 24th was well above. It was 3 times the average volume over the last 20 trading days. So in conjunction with that capitulation back here, using December 24th as historical precedent, you did have that MACD having a positive crossover, that black line up through the red. And then in conjunction with that, the RSI was emerging from an oversold position and started heading upward. So what I did want to do very quickly is share with you where we are relative to the potential that yesterday's huge drop on tremendous volume could have been capitulation. We can see that the MACD is not yet poised to have that positive crossover. We do see the RSI heading upward, but from this chart, we do have a sense that we are not quite there yet. And I'm going to show you some other charts that will confirm that for you, but quite simply, this extreme volatility is signaling an unstable market. So toward the end, as bear markets start to emerge out of their bear phase, this type of action is not anywhere to be seen. You're seeing much tighter, more constructive type of action, and we will go ahead and take a look at that. For right now, we're going to take a quick break, and we will be right back. Okay, let's go ahead and drill down a bit further in these broader markets. I like to take a look at the S&P sectors and as well as the S&P in this candle glance view. So you're looking at each of these little thumbnail charts is 2 months of trading activity. I go ahead and add this RSI indicator. You can add an indicator of your choice, and then go ahead and sort that in descending order. Once that's updated, what you'll be able to see is where the relative strength is within or among these underlying sectors. And I think there are a couple of things that will come to light immediately. The first is we can see that healthcare, real estate, and staples, your defensive areas, are right up here in the forefront. But really of interest to me is the fact that technology is holding up remarkably well, XLK. And I will share with you, let's go ahead and take a look at that chart on a longer term view, because it really is relative. That what I shared with you as far as the areas that are showing relative strength, you can see that in essence, it is not the prettiest of charts, but overall, the fact that it is withstanding a lot of the other sectors, they're well below their 200-day simple moving averages. One other fact to keep in mind with the technology sector is the fact that it has at least two stocks that comprise a large component of this group, and that is Microsoft and Apple. We're going to take a look at both of those stocks. That is one of the many reasons that technology is being held up. I'll share with you the others as well. So as we move on, we can see healthcare, real estate, and staples. Again, it's all going to be relative because in essence, they have clearly broken down. But as we move down into some of these other areas, industrials, that's going to be a lot in the way of those transports, airlines, so forth. Energy just really getting walloped with that shock earlier in the week to that area. And then financials are just continuing to collapse in the face of continued lowering of interest rates. Although it was one of the better performers today, you'll see that some of these washout areas that are super oversold will have significant bounces on days such as today. So let's take a look outside of those sectors. I like to put in some of these other areas of the market. We're going to look at volatility, the NASDAQ, how's gold doing, biotechs, also semiconductors, the US dollar, and so forth. Again, adding that RSI descending order, and we can update it. And no big surprise here because your volatility index is really way up there. Let's just take a quick look, a bigger, broader view of this volatility. This is that new methodology. I'm wondering if I can share with you very quickly a chart that will show the old way of analyzing this because it goes back historically a bit further, and you will want to be able to use that historical precedent to take a look. So I'm going to see if we can VXO, $VXO is the indicator, and we can see yesterday volatility reached an all-time historical high. And that was that, I was looking for that capitulation day as well. You'd have to go back to that 08-09 financial collapse to get that high. So really what I wanted to point out, and I mentioned this to you earlier, is the fact that capitulation, it's not exactly that precise day that the markets can turn, or actually as far as the VIX, we can go back to the 09 period. And I get more into this for those of you that subscribe to my MEM Edge report. I have a lot more in the way of information as to what yesterday's big spike in the VIX was all about. So for those of you that are not subscribers yet, I would urge you to go ahead and trial that. I have a special going on, and really the purpose of that is to keep investors such as yourself on top of where we are in the markets and what you can expect going forward. So let's go ahead back to our, let's see if I can get us back to our candle glance view, because there were some other outstanding characteristics that I wanted to share with you. And that was, we can see this is the US dollar really spiking today. And of course, we talked about volatility, but take a look. This is semiconductor, SOXX. This is one of the areas that I would argue is really helping technology move to the forefront. We can take a quick look because, again, it's all going to be relative. It's not a great looking chart, but the fact that it is showing relative outperformance is very interesting to me. I have a list of about 5 semiconductor stocks on my watch list for when the markets turn. They're super outperformers, unlike AVGO, which is hitting new lows, Avago, that's Broadcom, because they pulled their earnings. There is a very core healthy looking group of semiconductors that are going to really take off once the markets turn. And then we can see gold, very surprisingly, down here in the lower quartile, not really holding up well. I will tell you this as well. IWM is the Russell 2000 small cap index. Should the economy go into a recession, and certainly we are not poised there yet, but I will tell you small caps tend to be the biggest leaders out of a recession, but that's way down the road. We have plenty of time to review something similar of nature. Let's go ahead and take a look at some of those outperformers, and I'm going to share with you why they are outperforming, and you, of course, could then be the judge as to whether you are inclined to participate given the overall broader market indices and where we are. And here we are looking at the Scooter StockCharts technical rating for large cap stocks. And quite simply, it gives you these top. I'll tell you, I screen and screen and screen the markets. And then at the end of the day, I'll go to this, and I could have saved myself hours of work. But let's take a look at some of these top Scooter rated stocks here in the large cap universe. And Regeneron, these guys were one of the first to announce a possible coronavirus cure, if you will. You can see on this daily chart really hanging in quite well. RSI remaining positive, MACD also up there in positive territory. This pullback could be a buying opportunity for that one. But as we move down, I wanted to share with you some other areas that are holding in remarkably well and precisely why that is. DLR, this is Digital Realty Trust. This is, again, a rather sloppy chart, but what I did want to share with you is the fact that this is one of those areas that is viewed as somewhat recession proof. And the primary reason is because this is a REIT stock. They provide data centers, and that is an area that is expected, regardless of the coronavirus, there is going to be expected to be increased demand. The stock yields 3.3%. And we can see it's hitting a new high. Let's take a look at another stock, Kroger. Those of you that have been following the news with people hoarding various consumer staples goods, toilet paper and so forth. Kroger is also holding in remarkably well, found support, bounced off of this 50-day simple moving average, RSI, up there in positive territory. They are deemed one of those that will benefit. This is another recession play, SBAC. This is a REIT stock that provides towers for the telecommunications. Again, a rather not particularly impressive looking given, but this is what we're seeing in the markets. So SBAC, a little bit of a yield, 0.7%. But they are in that communications area, providing those wireless towers. So that's another positive area within the markets that's viewed to continue to carry on. We can go ahead back because I wanted to share just a couple of other names. We can see some of these semiconductors up here in the forefront. EQIX, this is another data center related REIT stock. It yields 1.8%, bouncing right off that 200-day simple moving average, breaking back above the shorter term simple moving averages, RSI. We're not quite there yet with the MACD, but again, really quite simply because there are well over 6,000 stocks in the market, and to have this ability to just get your arms around outperformance strength very quickly is really very powerful. So here is a look at Apple. This is something that I did want to share with you, Apple as well as Microsoft. Again, a lot of other stocks and areas are well down below this key 200-day simple moving average, this blue line. Apple is really holding up quite well. Analysts came in, two different analysts this week came in and raised their estimates for Apple. While we're here, let's just go ahead and take a quick look at Microsoft, another one that is now back up above this 200-day simple moving average. So relative outperformance in those bigger areas among technology. Let's go ahead and drill down into mid-cap stocks, and we can take a look at some of these other areas that are outperforming and could very well continue. Sprint, this is another one that outperformed during the 1980 and 88 recessions. Sprint was able to outperform. Now, this, of course, is this big gap up with their merger with T-Mobile, and we can see it's holding up well. Again, not your prettiest of charts, but just as a note that it has been recession-proof in the past. So again, we're going to go ahead and take a look at some of these other mid-cap stocks just to keep in the back of your mind. We are seeing within the Chinese markets a couple of bright spots. This TAL, a number of their educational stocks are holding in well. This is very like other bear market periods. People kind of resort to educating themselves so they can, depending on how the economy goes, they will be better, certainly more employable. Vips is a big retailer online. They do everything from large appliances on down, and it's actually holding in remarkably well, VIPS. Let's take a look at, again, mid-cap. Another area that is holding in well are some of these food deliveries. This is Domino's Pizza, DPZ. We can take a quick look here. This is a gap up on very strong earnings, and the stock, for the most part, is relatively outperforming. One last name in this mid-cap area, because I wanted to make sure I didn't miss sharing a couple of other areas of the market with you. And this is Virtu Financial, VIRT, and this is another Asia-related or Asia-facing stock in China, and they provide, actually, pardon me, this is Virtu Financial, and VIRT is this ticker. We're looking at it daily. These guys actually are China-related, but they provide liquidities. They're a market maker, cash, futures, options, and so forth. And we can see that there is an extensive need for the ability for these market makers to keep the markets alive and going well in an otherwise tough market environment. Let's take a look. I did want to make sure that we didn't miss out on a couple of other areas, because I did have a chart of 1987, and I want to see if I can find that. That will be in my newsletter if we don't get to it today. So again, go ahead and trial that. There's a lot of relevance there as far as what what it looks like when we are coming out of a bear market as opposed to where we are now. So moving along using these StockCharts technical rating reports, I talked about this last week, the ability to use these ETFs to get in front of where the outperformance is in the broader markets. And certainly for those of you, I mentioned to you that the volatility index reached an historical high yesterday. And so a lot up here in the forefront is these velocity. So what I like to do when you're looking at these ETFs, not all of them are very widely traded. So I like to take a look at the volume. When I see high volume characteristics, that is going to indicate to me that this ETF is more widely traded, and your bid and ask is, you're going to be easily able to get in and out of that. But of course, we can see VXX has really already had an extensive run. Depending on your thoughts on the market, we could easily continue to see very heavy volatility. So that is one that we can take a look at. And then also, let's go ahead back to this ETF here. And I think I do have to leave it fairly soon, but I did want to share with you some of these other areas that are up here in the forefront, some of these bond funds, but they really fell apart this week. So whether that is an opportunity to get in or not remains to be seen. And then I believe that I will need to leave it at that. For those of you that are actively trading the markets, be safe, because the overlying theme is we are in a bear market until we see a system. In fact, my work, I do have a proven system that has identified the downtrend reversal from absolutely every bear market period. It's done so successfully. So it's something that I outline again with my MEM Edge report. So I urge you to go ahead and trial that.